On that note, Annetta Markowska is chief financial economist at Jefferies. Annetta, welcome. This week ended very differently than it began. And what do you think the message is here?
Look, it's obviously a mixed picture. Housing's still very weak. I think will continue to move down. But to me, the consumer is very important. And it really does look like we hit an inflection point in July, with gas prices declining, inflation basically stalling. Real wages increased in July by 0.5% month over month. And that was the first or the largest increase since 2000. So this narrative around negative real wages squeezing the consumer, that's inflecting, and that's starting to move the other way. In August, real wages will be up again, almost certainly, because inflation is on track to actually contract. Our models suggest the CPI will be down about 1 to 2/10 in August. And so, again, that'll drive another increase in real wages. And I think that sets the stage for a reacceleration in real consumption. There's no evidence that nominal spending is slowing. And really a big reason for that squeeze in the second quarter was just this massive price shock, which is now clearly reversing. So, whereas I think consensus is looking for that downward momentum to continue to accelerate to the downside, I think the surprise in the third quarter is actually that real GDP is going to accelerate pretty meaningfully.
Yeah, and you've been correct about that up to this point. And I think, speaking of setting the stage, we have Jackson Hole next week. We're already getting a lot of very pointed, I would call it, Fed speak. It's kind of refreshing, actually, to hear Fed members sort of popping off about inflation the way that they are. But then there are discussions about whether there's a split at the Fed or what next week might hold. So what are your expectations?
Look, there's no question the Fed will maintain the very hawkish message. But I think you have to sort of break it down, right? There is a question of how high will they ultimately have to go. And that's really what they've been pounding the table on, right? Suggesting the terminal rate might have to rise to 4% and then stay there for a while. But they haven't been as aggressive in terms of, talking about just continuing to accelerate hikes. In fact, I think the message with respect to the pace of hikes has been a little bit more balanced. We saw that in the minutes. The Fed now understanding or underscoring the two-sided nature of risks. They're obviously aware of being behind the curve, but they're also worrying about maybe moving a little bit too far given the long policy lags and what has already been delivered. So, I think for the September meeting, it's still a very, very close call. We're actually leaning toward 50 because we just see inflation, the slowdown in inflation, the declines in inflation expectations, sort of giving the Fed a little bit more wiggle room and allowing them to move a bit less aggressively. And frankly, it makes sense now that we're approaching the neutral sort of rate territory.
I guess my final question, and it's not maybe necessarily one you can answer, but does it make sense to you, the behavior of interest rates? And we see how sensitive they are to this recession argument, right? Weak data on Monday, we were below 280. Stronger data by today. And with the Fed speak, we're basically back at 3%. And, we've been range bound, but then we keep kind of having this upward pressure. Maybe some people are saying it's more what's coming out of Europe. But what's your gut feeling about it?
So I think directionally it makes sense, right? Again, my base case is that we'll get to a 4% funds rate by March. And certainly the market isn't yet priced for that. So I think that the fact that we're repricing in that direction is not surprising. The timing is a little bit surprising because, the market sort of spent the better part of the past month ignoring Fed officials who were saying, hey, terminal rates are too low. We're not going to be cutting next year. And all of a sudden the markets are listening this week. So the question is what changed? I think the CPI numbers out of the UK maybe sort of spooked the market a little bit. But I think the market will have a hard time getting to that 4% terminal rate being priced into the curve until we actually get closer to 2023. Just the part of it is maybe a misunderstanding of the Fed's reaction function, but the market's also having a lot of doubts about the Fed's ability to hike next year or continue to hike next year, and the economy's ability to withstand those hikes. And I think the market just won't have the confidence in that until we get quite a bit closer to 2023. and kind of get confirmation that the economy is still standing.
Yeah, and it's an unusual feeling. We usually talk about, we're pricing in events 3 and 6 months from now. And what you're saying is this is going to take so much convincing for investors that it basically will have to happen in real time. And then we'll have to just see the fallout in that case. Annetta, great to have you. Thanks for your time today. Have a great weekend.